You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
Hello, everybody, and welcome to the option block. This is a show that, well, we run down everything there has to do with what's going on in the markets, what's going on with options. All I know is it's the only show that I want to listen to for options. At least it's the only show that I'm allowed to co-host for options. I'm Andrew Giovinazzi. I'm the Chief Operating Officer of OptionPit.com, filling in for Mark Longo, the big shoes of Mark Longo, the CEO of the Options Insider Radio Network, global media conglomerate. But with me, lucky enough, I am fortunate enough to have Mike Tussaw of RCM Wealth Advisors. Well, just where are you, Mike?
I'm in a lot of places, but right now I'm coming to you from lovely, sunny, scenic St. Charles, Illinois.
You know what's funny is next time I go to Chicago, and I went all over to the Chicago suburbs, I have to say I never went to St. Charles.
Oh, you're missing out.
Now that there's the pickle capital and all kinds of stuff, I think I missed out a lot. I did a lot in Chicago, but I didn't do that.
Chicago has nothing on St. Charles, by gosh.
Well, with our cast of characters, which is two, although I do miss Longo. I miss the voice, I have to say.
I have to agree.
With the two of us here, we will dispense with more introductions and get down to some trading. We will get to the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
All right, here we are with the trading block segment. This is the this is the part of the show where, what's catching our eye today, what's going on, what are the things that make Mike Tussaw get out of his chair, get off his computer screen, do a little spin around, and celebrate? Was there anything like that today for you, Mr. Tussaw?
The market actually went down.
Can you believe it?
That's not in the cards. No. Today was one to where what I was looking at a lot today, I didn't get into any greater bullish positions or anything. Still holding off a little bit on adding more to the market on a dip for the time being anyway. But what I was looking at was the fact that we did actually come down around midday today. Market started up, but we had a little bit of a sell-off going into the end of the day. I thought that was a little bit interesting. But really, the fact that we're calling 0.33% move a sell-off kind of shows how big this actually is right now. So not a lot, but by relative terms of the recent market, you could call this a zombie apocalypse sell-off like none other.
I can just tell you that since I do own a little downside protection, there will be no sell-off, because that would make me too happy, and I don't think that's possible. Although I did hear a rumor that Ryan is leaving his job as Speaker of the House. And I don't know if that hit the tape in a weird way as far as, is he going to do it before or after the tax law? I believe the last thing I read was he was going to leave after the tax law. Basically, I guess he was going to leave on a high note and bail. And I think that might have had a little bit to do with the SPX grinding to a 10-handle loss. So did you hear, does that news get out there in St. Charles, news of that nature?
Well, the carrier pigeon didn't come in yet today, so we didn't get that news. No. But the fact that if something like that's just a 10-handle move, I mean, that's especially with how politicized our news environment is these days. I still kind of think that just shows the strength of what this market actually is.
I don't disagree. They want it still.
Had Newt Gingrich have announced that he was leaving the House in the mid-'90s, or let me rephrase that, in when Gingrich and Clinton were having their classic fights like they did, and Gingrich would have announced that he was leaving right in the middle of it, not later, but right in the middle of it, I think that would have had a lot bigger move on the marketplace than what we're having right now, because the Speaker of the House is a very highly publicized position right now. Everyone hears about Paul Ryan and how he kind of seems like he's begrudgingly agreeing with stuff that Trump's doing. And it's one where when something that big happens, I really think it should have moved the market more, quite frankly.
I did too. I thought another curious thing was VIX up because this is the 14th. So VIX was up 30 cents, still ticking up a little bit after the close, but all the vol futures actually dropped fractionally, just enough, but a little. They went up for a little while today on the first announcement, but the vol futures kind of sagged a little bit. So, unless this changes things, hugely, at least the volatility traders did not really care one way or another for it. Normally when you think about it, you have VIX down, SPX down. Futures should be up a little bit, but they weren't. So even up to close to the close, that VIX was actually almost down fractionally too. So we are not getting much of a move. So actually, I think relative SPX down with VIX only up 25 cents is almost like volatility dropping a little bit across the board. Certainly, at least today, the futures are down a little bit. So we'll see what happens tomorrow.
Nuclear war can't bring the VIX above the 10 handle. Then Paul Ryan's sure not going to do it.
I know, and I was trying to think of all the froth. So anyway, I see that as it looks like the tax thing is going to get done. I don't think there weren't enough tweets to change things. It's funny. I was having a conversation with one of my clients today that we were laughing about, Trump being the single-digit VIX president, which is strangely true. However, for most of the year, we noticed there was a lot of future premium and VIX future premium over cash. For all you VIX geeks out there, I think that's kind of an important thing. But that premium has started to it's eroding a little bit. It wasn't as high as it was earlier in the year. They used to kind of hold it into the bitter end. So we'll see what happens with this cycle. But I find that the premium wasn't in the VIX. It was in the VIX futures, I guess. That's where it was hiding for this whole year. So maybe that's something that Mark can discuss tomorrow on vol views. But on other trading block things, and there's this product out there, Mike, that I don't know if you've heard of this thing, but do you know that the market value of all cryptocurrencies is now $500 billion?
What's that product called? It's like
biz something.
Fitbit, right? Bitcoin.
Bitcoin.
Bitcoin. Oh yeah, that. How can I forget that?
I just and what's funny is everybody's looking for a bubble in the equity market, right? Well, all of a sudden, kind of without a whole lot of noise and fanfare, like I've seen people now on my Facebook feed who I think would have never thought, like, what is a Bitcoin? Now they're asking because it's up, 1,000% this year or something like that. But all the cryptocurrency, I heard now there's 100. There's 100 of them. And I don't know exactly, what you get for them. There's some merchants, a lot of, I guess, merchants now. I think Square, ran 50% or something on the fact that they were going to start taking Bitcoin or doing something with Bitcoin. Certainly the CBOE and the CME are listing the futures, but $500 billion, don't you find that do you find that problematic as far as market cap goes? It seems kind of high.
Well, I was having a conversation with a client today on Bitcoin, and the surge with which we've had in Bitcoin is nothing short of amazing. There's no one that's going to argue with that. I believe it was worth a penny in 2010 or 2011. I have to look it up to confirm that. And then now it's up around 17,000, 18,000, who knows, within the last hour or so what the futures did with it. But it's not what the conversation that we were having was along the lines of one of the reasons, and if it's that big, and this is kind of a question that I would ask, if it's that big, could this have contributed to gold and silver falling after around 2012, right after they both peaked? Are the people that are all the gold and silver zealots? I believe in having holdings in gold and silver. Don't get me wrong. I've said on this show many times, but I'm far from a zealot. And the allocations with which my clients have, you'd agree with me if you could see them. But my point is that the zealot crowd, the crowd that is looking to hide things in gold and silver, the zombie apocalypse people, are they now no longer investing in gold and silver as much? And are they now going with cryptocurrency? Is that now the new thing to where what is everybody going to do when the U.S. government fails, the dollar's dead, and that type of thing? Could that have contributed to that in some way, shape, or form? What are your thoughts on that, Andrew?
I think that's part of it because I remember because we've had clients mining Bitcoin for I think since 2012. Do you guys remember? You remember when Cyprus went bankrupt? They had that, and then the EU decided just to cut them loose. They said, "Screw it, you're going bankrupt, and your bonds are going to fail, your banks are going to go to zero, and all that kind of stuff." And I remember at the time, Bitcoin, and that's the first time I've heard of it. Overnight, it went from and the numbers could be totally wrong, but it was a pretty meteoric move. It was, let's say, $30 to $60 for a Bitcoin. But it could have been 100 to 200 or 25 to. It was just a huge move. Because every once in a while we'd still have that euro was shaky thing, and all during that time, I remember this Bitcoin thing going up, and then you got to mine it, and I go, well, I don't want to. How do you mine it? You got to set up some computer thing and try to figure out how to do that. For me, it was just a hassle, like to think about it, and then I didn't think about it ever again, pretty much until this year. Option Pit had and when we had our Pro Trader Summit, one of the guys that was there, he was like, this Bitcoin, and it's going up. And it was, I think, $1,500 at the time, something like that. And I'm like, well, wow, you could have bought a few of them or something. But boy, he was right. And he liked all the other cryptocurrencies. And that was one of the reasons he gave, because as an alternative, it's still kind of a faith and credit thing to me. It's weird, but because now a Bitcoin is worth about a car, so okay, now you have to give somebody has to take your Bitcoin to buy a car. It's a weird, I guess, currency confidence is a strange thing, and right now merchants are taking it, but if they start taking it in trade goods and it goes from 17,000 to 9,000, if that's, it's possible, I guess it could happen. Are they still going to want to take it? And if there's any snowball of them not taking it, what does that do? Because I think the real jump in it came when, I think this year, when retailers and people started accepting it as a payment transfer for just, regular goods and services. and maybe probably the show listeners will correct me on that one, but I thought it's only really happened within the last year. I don't know. Do you remember anything even remotely related to that?
No, but I was reading up on some of the history of Bitcoin that I found fascinating. I think the first ever Bitcoin transaction, I don't even know if it was in America. I think somebody paid 2 Bitcoins for a pizza. And right now, that's arguably I would say not arguably, that's the most valuable pizza in the history of planet Earth. And so
I hope it was worth it.
It better have been a darn good pizza for 35 grand or whatever it would be now. So I'm very skeptical about it still, but keep in mind, this is coming from the same guy that said that Starbucks was a horrible idea when I was doing a project on them in college. What idiot would ever pay $4 for a cup of coffee? So it shows what I know about startups. But the reality of it is that it's here right now. And what I'm looking to do personally with this is that sometime in the next few months, there's likely going to be an ETF and some options on it in some way, shape, or form. I'm going to try from just some speculative money, not a huge position. I'm going to look to buy put spreads on it or puts or whatever the case may be. Who knows what volatility is going to be on it and how the volatility skew is going to work on it. But I'm looking to do something in a limited risk, bearish fashion on Bitcoin when options do come out on it. Because I think personally that the fact that it's gone up so much and the fact that everyone's so eager to trade it, I mean, you and I have been around a long time, Andrew. Whenever there's this much excitement about something, it typically doesn't end well when you jump in. Now, when it's going to end, that you don't know. But a lot of time, more times than not, it doesn't end well. And those are kind of the odds that I'm playing with it. So if Bitcoin does go up to 100,000, well, I'll gladly, well, maybe not gladly because I wasn't in it, but I'll gladly eat crow on this. But I think that this is a fad. At some point, it's not going to end well. And I think that just at the right opportunity, I'm looking to buy some type of limited risk, bearish strategy on it in some way, shape, or form.
Well, you know what? You would be in good company because, and I think this is from I think none other than Taleb kind of says the same thing. He's like, is it a bubble? Is there any way, there's no way to properly short it, and any strategy that doesn't entail options is non-ergodic. Now that is a Taleb-esque word, right? Subjected to blow up. Just as one couldn't rule out 5K or 10,000, you can't rule out 100,000. So the fact that there is some futures now adds a little bit of liquidity to the mess. But I agree with you. I've also seen stocks go up and up and up and up and up, and they eventually stop, but you can certainly get broke trying to short them. So I think it might be best for us to wait for options. I think once the futures start trading, I think they should list options on, I think the options listed on them. What's going to be interesting, though, is it's going to be 100 realized vol in a $19,000 or $16,000 product. So the premium, what's the premium on a straddle going to be? Let's see, at 10% of the value or 15% of the value, the straddles would be like $3,000 for one straddle at least, maybe $4,000 for depending on the term of the straddle. So even a one lot's going to cost you to play in Bitcoin. So it will be very interesting on how, because all the pricing's relative, but 100 vol is still 100 vol for that thing. So I look forward to being able to sit and try to figure it out once they list it. But for now, I've definitely I am an observer, nothing close to an expert on it by now, because all the experts were already long it. So I guess now you're just sitting watching.
Right. And just so the audience knows a little bit about who Taleb is, Nassar Taleb, he wrote the book Black Swan. He is legendary for putting money into his fund to where a lot of it will be in government treasuries, and then he'll buy some long shot puts or put spreads or something along those lines. And then the one time that we do have a major downturn, he does really well. Maybe not necessarily the one time, but he's very much looking for the inevitable time when the markets just come crashing down in a major way. And that's what he does. And so it's really not surprising, his stance on Bitcoin.
I think, and I don't disagree with them. The fact that it can go anywhere, it can sure get anywhere. That's another thing. So we'll see how all that turns up. I guess I think at this point maybe we should close the trading block and get to the show. That is the we have to put on a fedora and look at the CME underside. We will cruise on over to the option block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Hello, everybody. This is the option block, the odd block. This is a part of the show where we look at unusual activity, the CME underbelly of options trading, mostly just big money. Where are they going? What are they doing? And what we do is we give our listeners a little insight into big volume trades. And I think what has become Mark's favorite part of the show is it's the hunt for long-term puts in Tesla. These are the Jan 2019 50-level catastrophe puts. And let's see what our open interest on them is today, because you got to look on them every week. And the open interest has climbed another 183 contracts. Tesla's kind of been all over the map lately, I guess, shipping their truck or saying they're going to ship their truck or something like that. But the 50 puts that were a little bit cheaper are now 64 bid at 65 and 183 traded today for an open interest of 34,973. So that is nothing to sneeze at. So, Mr. Tusa, have you jumped into any of these Tesla puts yet?
I'm going to really surprise you with this answer, kind of.
Very interesting.
I can't resist it anymore. What I'm doing right now, so figure, what did the price of those 50 puts close at today? What, $2.50?
Oh, no. Like, they're still, the Jan 2019 puts are 60, the 50 level puts are 65 cents.
65 cents. Okay. So what I'm looking to do right now, and I'll have to let you know how this goes. Let's say that you get into that put for, in theory, $1. I know it's not that much. Okay, so for 50 cents, let's say. So that means that if Tesla were to go to zero, then you would make 100 to 1 on your odds. So what I'm going to look to do is I want to do the 55-50 put spread. I went out to January of 2020 on this, and I want to see what I can get filled at, because I looked at what the bid-ask spread, the midpoint of a bid-ask spread on the 55-50 put spread in Tesla for 2020 is around like 4 or 5 cents. And so I'm thinking, okay, I'll risk $5 for the chance to make $4.95. You're literally only risking $5. So I put out a scout order today for literally a one lot at 10 cents, and I did not get filled on it. So I'm going to play with that a little bit, just from that standpoint, to where if I can get those kind of odds on Tesla going bankrupt, I don't necessarily think it's going to happen, but it's kind of like the Chicago Bears, for example. Let's rip on our hometown team, by gosh. It's not mathematically possible for them to win the Super Bowl this year because they're out of the playoffs, but the Chicago Bears winning the Super Bowl next year, the odds aren't that great. But if someone wanted to offer me, say, 500 to 1 odds on the Chicago Bears winning the Super Bowl, I'd take that bet just based on the odds alone. And so what I'm playing around with right now is to get some type of odds.
Well, let's see if you can. I think if it will be very interesting to see if they're going to give you that position for a dime. I have a feeling, just from my old market makerville, that I would not let those spreads go for a dime. I would make somebody pay like 30 or 50 cents or some totally obnoxious price.
That's what I would do too. That's what I would do too, but you never know. There might be someone just desperate for the paper.
I like that. I like that in conception, though. You're like, all right, I'm just going to put this nickel bid in for 500 spreads and see if I can get filled. I just actually this is a slight subject, excuse me, in our chat room about Tesla. Actually, just somebody said, I think Chanos, who's a famous short seller, thinks it's going to zero. He's usually pretty good. It's just the question of what's it going to cost you in the meantime? Because I just looked at it recently. It was almost $300 again, and it's just rallied $40 on, I don't know, more announcements that something might happen or the trucks are going to ship or something like that. So I don't know. I like the Elon Musk guy just because he's done some amazing things, and maybe he will succeed in his high wire act, which I think that's kind of what it is right now, is sort of a high wire financing act, with kind of all these myriad businesses he has. But we'll see. All I can say is we'll see. So we'll keep an eye on Tesla and any more volume in there of interest. Also, I think this is an interesting one too. In a Time Warner, Time Warner is being bought by AT&T. There's antitrust issues. There's all kinds of stuff like that. So the symbol is TWX. And the thing is, last year, so this takeover has been going on for quite some time. I think Time Warner at the time was trading around $80, something like that. It has been as high as 105. And now there's still kind of this antitrust stuff. So that was what, October. Then there was, the kind of the fight with the administration, blah, 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 blah. And we find ourselves here, Time Warner trading 89.65. So it's about $24 below its highs. The trade blocks that went up today, pretty huge size. The July 2018, 105 calls, traded $1.15. Next on the tick, that's 40,000 times. Next one, the July 95 calls trade 465 40,000 times. So it looked like the customer was buying the 95s and selling the 105. So that would be a cost of right around $3.50. And then they are trading the July 2018 82.5 puts 30,000 times, a little less, for 360. So net, they are getting a dime credit for the whole position. So it looks like either they're taking off a position where they were short the 95-105 spread and they're buying it back, and they're closing out the put side of the position. So if they were short that along the puts, they could have used that as some sort of collar trade on it. But what I think is happening is, and we're going to see the open interest tomorrow, is I think they're actually piling on and adding more. I know it's hard for you, Mike, if you have any idea about this, because this is not exactly your normal trade style. But it looks like they traded the upside call spread and short put for a dime credit, and if the deal goes through, the trade would pay basically $10 as it's structured right now.
Not a bad deal along those lines. And would that qualify as getting your juice for free?
It would qualify as getting your juice for free, I have to say, because the basically the losing price looks like it's only a couple of bucks above where Time Warner was before the deal was announced anyway. So, Time Warner goes back to $80. They would lose a little bit on the trade, but not much. They take delivery of the stock. So it seems to set up well. So the interesting part was the open interest on this trade was already 60,000 contracts on the call side and almost 50,000 contracts on the put side. So if they're adding to this, then they'd have this on 100,000 times, which is not a small position in option world, I have to say. It's not a very small position. What's funny too is I was looking at this and I was thinking, who owns a lot of Time Warner? What guy would own a lot of time? I was thinking, maybe it's what's his name? Who's the guy that started CNN? I can't remember. Ted Turner, right?
WCW as well, I believe.
Yeah, so maybe I wonder if he used this as a collar initially, right? Maybe he sold the 95-105 call spread as a collar, and bought the puts and just kind of locking in a high level price for his shares. But again, curious, don't really know what, but it would be a very cost-effective way to try to trade this buyout with AT&T is all I would say. Because the worst comes to worst, you pretty much take delivery of the stock back to where it was before the whole takeover deal was. So this smells like a risk arb play to me, that has less risk than your average risk arb trade. So that would be my my take on that. But they're closing it down here, I guess, or they put it on at really great prices at the top and they're taking it off now. So worth keeping an eye on to see if the risk arbs are piling on that a little bit more. Another one here that I find interesting is in Symantec. The symbol is SYMC. And somebody wants to trade some Jan 35 calls for a penny. And they want to trade a lot of them. It looks like 42,000. And this is an odd trade to me, mostly because the open interest is 44,000, but now all of a sudden bids are popping up all over the place for these options. And again, this is a curious purchase just because of the fact that the stock is $28. It's kind of a utility type of technology company at this point. Why? I guess somebody's either covering some short options. But the options are now 2 bid, or basically they're 2 cent bid at 6 cents. So again, that's, to me, I'm finding that as an odd trade versus what's going on right now. So who sells? So here's the other. No matter what is, who sells 41,000 of those at a penny? That's my question. Is that a two-saw type of trade? Is that a what is that? The strategic night fund kind of buy right where you sell the 35s at a penny.
We really want that penny, by gosh.
I'm guessing it's a wild guess for me from my side, but I'm saying that's not a strategic night trade or anything.
Not exactly. I know volatility's low and we're not quite getting the same premium we have in years past, but it's not quite that low.
It's hard to sell the pennies, I have to say. It's not an easy thing by any stretch of the imagination. So selling the pennies is definitely not something that I want to do. So next on the list is SN. And we have Sanchez Energy. Oh, my word. Pretty large size Jan D6 put roll. The price is 129 over 125. It looks like this stock is the I guess it's the winner of the it was something, now it's nothing. It was a $13 stock and now it's a $4.50 stock. And there's massive open interest on the December 6 puts, about 14,000. and there's almost no open interest at all on the Jan 6 puts. So somebody is rolling out, trying to get, and actually they're already underwater already because the stock is 453 and the put spread traded 129 over 125. So the intrinsic value on that strike is $1.47, and the puts are and the puts are already only trading $1.25. So that to me doesn't look like a great put spread to trade in the first place because it's all underwater. So the customer who rolled to the Jans got only 4 cents for their roll. So let's say, Mike, if you were short puts, do you use the put roll sometimes? Like, well, I don't really want to take delivery, I'll just roll my puts. Why would you do that if, let's say, just because this customer did it, not a small amount, over 10,000 times? Would you do it for 4 cents?
Probably not for 4 cents. Sometimes I would if it's a smaller amount of contracts. And the reason is that at brokerages, the cost of taking ownership of the stock is greater than simply buying the stock outright, and the exercise versus the actual payment for the stock. That can be a factor, but it would only be with smaller amounts of cash that's available.
Yeah, again, 4 cents for a roll, you get almost no premium for it. It's, I guess the only thing I can say is we've highlighted some interesting large money rolls at this point, large money trades. At least for today, looking at some of this stuff, I don't see this is just one of those, I would say, just unfortunate. Somebody has probably short some puts and they have no choice but to roll them. They don't want to take delivery, and hopefully their bad news will end at some point. But I've been on the receiving end of that as well. So I can understand at some point you just keep rolling them and you figure you're going to take delivery at some point, but maybe you might skirt it a little bit. But it looks like Sanchez Energy is definitely something that is, I think they're having some trouble. They're having some trouble still. So anyway, with that, I think that wraps up the odd block, and we will roll right into, I guess this is the portion of, we will roll right into the mail block. This will be our listeners' portion of the show.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the Mail Block. This is where we take your questions. We ask a question of the week. We do. And this is where I test Mike. Hopefully I test him the right way on this. But this week's question, the QOTW. Here's this week's question. Now, see if you can divine what's winning, at least as of today, right now, when we posted this. As of right now, at least, trading options during earnings is a coin flip, but you love to do it. What's your earnings options MO? So here's what your choices are going into earnings. And then you hear your choice, and then you try to tell me what you think everybody has said, and then what you want to do. So first off, you can buy calls or call spreads. You can buy puts or put spreads. You can sell puts or put spreads, or some kind of iron fly, or iron condo. So first, what do you like to do, and what do you think other people like to do?
I would say buy call spreads, and I will say other people fly or iron condor.
Oh my gosh. All right. That's pretty good. As I have it right now, 38% of the people said flies or iron condors. Because of, I was just going to assume premium. You got number 2, 27% said buy calls or call spreads. Now my big thing here is, the thing that everybody thinks about with option premium and earnings is, oh, it's super high, it's really expensive, it's overpriced and all that stuff. What everybody doesn't understand, there's a reason that the implied vol is so expensive, because the Black-Scholes model has a hard time pricing one-day events. how does it price one-day events? Because it wasn't really made for that. It was meant to price volatility over a longer period of time, or an option price over a longer period of time, given a forward volatility. So the problem with the option model is it's kind of almost the implied volatility is very high because the liquidity providers have to change the way they think about the trade. But also at the same time, the potential underlying price is not what it normally is, right? So when you think about an option trade, you usually have it's priced on whatever the current stock price is, but moving at sort of, let's just call it its average volatility for a period of time. So when you're pricing, or when you're looking at earnings, you can't look at it the same way, because you're looking at a one-day event, or you have a high degree of confidence that the amount that the stock can move is more like a 3 standard deviation or 4 standard deviation move. So when you look at option pricing in earnings, it's actually closer to pricing what the potential one-day move is going to be. So it's much more, the options are actually more fairly priced for earnings, even though people think the volatility is very high. It's actually not as high as you think, given what potentially could happen. So under normal circumstances, a stock can move up or down, whatever its average realized vol is. So let's say realized vol is 20%, and the option prices will be, most of the time priced around 20%, if that's kind of what the underlying does. Think about, like a GE or an AT&T or something like that, kind of a 20% vol. But that's over a period of time. Once you get to earnings, you throw all that out the window, because the potential move for that day is expected to be much more than average. So the options are pricing that expectation. So flies and iron condors, it's popular for people, I think, because there's a lot of the literature that says, oh, this stuff's overvalued or it's too expensive, and sell it. And a lot of times that happens, but it's not as crazy overpriced as you think relative to what really can happen on that day with earnings. So I don't know how much real edge is there, but the fact that it's still the most popular type of trade in the listener poll means that people think that there's some edge there, or it looks like a good odds-on trade. So anyway, that's just my 2 cents on that as a for the question of the week, and just in general on those type of trades. I'm not much of an earnings. I like trades before earnings. I think there's more money to be made prior to earnings in a lot of these names, because of the way the vol sets up. And after earnings, kind of selling the vol once the earnings are out, because there's some latent vol in there usually could sell. But I think the least interesting place is actually trying to hold it through the earnings announcement. But that's my 2 cents on that. Mr. Tusa, do you have your own 2 cents to throw at that?
That's about it. I'd throw 2 cents at it, honestly, for earnings plays, similar to my potential Tesla trade that I'm doing. I typically try to avoid trading earnings. There's times that I'll hedge against an earnings announcement if I have a larger position, but I've just never had any success with it. Not to say that it can't be done, but I just feel, to me, it is a coin flip. And I think there's much better ways to make money, and I typically try to avoid it. I personally hate it when we have earnings announcements on whenever I have a holding that's having earnings announcements, just because I have to do a lot of work to hedge it. Not that I dislike doing that, but it's one of those ones to where I'm typically of the school of thought that let's not try to get hurt too badly if it goes against us.
I know. One of the things is, one of my clients says, lose small. It's a lot easier to make money trading options if you never lose big. So I think I'm more focused on just, making sure that thinking ahead, but that's the problem with some of those earnings plays, where you could just lose huge, and then you're starting back you're starting in the hole. Just not I don't think that's really a great place to be. What else? What else do we have? Do we have some more listener mail? I'm looking. And let's see here. Here's a comment from Tom. Let's be honest. If any of us had sized Bitcoin, we would have sold out ages ago and probably be kicking ourselves right now. So anyway, we can roll. Do you have anything for a strategy block for us today, Mr. Tucson?
You know what? Let's hold off on that till next week because I want to make sure that we can get to as many listener questions as we can, and have time for around the block and everything else that we got to do.
Also here, let me see. I've got one more that I want to go here. Let's see here. From the Giddy Franciscan, sell in May and go away. One option strategy benefits from the profound market malaise that occurs over the summer. Do you have anything on that for? I know this is the middle of winter, but should we start getting ready for the malaise since volatility is only 9 anyway?
Yeah, we're going to the sixth VIX. By gosh, no. There's funds out there there's mutual funds that actually become far more conservative in the summer just for that reason of the old adage of sell in May and go away. So there's a lot of there's a lot of statistical data to back that up. Not to say that it works every time. It hasn't a lot in recent years, but when doing that, I think the simplest way to do so would be to just simply go flat for the summer if that's what you want to do. If you're bearish in the summer, then of course, if it's sell in May and go away because you feel it's going to be less volume, more volatility in the marketplace, and markets could go down, then a beloved vertical put spread in some way could be a go-to strategy. But for the most part, sell in May and go away, the go away is a very key part of that strategy, and so being in cash would be the important thing to do, I think.
I like that because if you really want to go away, you've got to go away, and then you have to. That means get out, and that means you also, if you have a rally all summer long like we had this year, you're going to be a little grumpy because you'd be kicking yourself in the head. I think here's another. Let's see here. Did I do this one from Tom? Let's be honest. If any of us had sized Bitcoin, we'd have sold out ages ago and probably be kicking ourselves right now. Did I just read that question? Sometimes my head. Hosting the show is really hard. Trying to keep all this stuff in my head, keeping all this stuff going.
It's not easy.
It's not. Actually, I think we've had clients that still are long Bitcoin. Actually, they've gotten out of a lot of it, but they still actually have some. So there you go. There's the answer to that question. Not everybody has sold all their Bitcoin. And let's see, one more piece on this. What is the cheapest way to hedge my portfolio with options? Do you have anything on that one for KBX32?
There's a lot of ways. We could spend literally days on that question if we wanted to. Typically, the cheapest way of hedging a portfolio, if you have a portfolio that's beta weighted relatively similar to that of the S&P, you can use the SPX, so that way you're not buying options on all the individual underlyings with which you have. That's one way of doing it. The other way is depending on what level of hedge you want. If you're thinking, okay, well, if the market were to go down 10%, I'm a buyer because if I like the market at this level, I love it 10% lower than that, then I personally would be a big fan of buying a put spread. The other way with which you could do it, if you're flat, you want to have exposure to the market. This is what we did a lot of in recent months. Sell an out-of-the-money put, buy an out-of-the-money call for even money, or in our case, I think we actually got a nickel for it, so you'd be proud of me, Andrew, for getting my juice for a credit. And by doing that, you have a cushion to the downside. I think we did on SPY when SPY was in the low 250s. We did the 225, 262 risk reversal. We did it for September of 2018. It's doing really well right now. But now we're at a stage to where, because it did so well so quickly, we have a lot of juice in that 262 call that we need to now manage because of the fact that we don't want to let all that juice go away should the market go sideways for the rest of the year or for the next 8 or 9 months. So I would say, in terms of the least expensive ways of doing it, SPX is usually a good way to go. Put spread is another way of doing a put spread would be another way of doing it. For hedging a portfolio, I am not a fan of buying the VIX for that. Yes, you can make an argument of historical correlation, but it's not 100%. And so if I want to hedge, I want to hedge, and that's how I do it. Not against trading the VIX, obviously. Andrew and Mark do very well at that and know a lot about it and educate the masses on it. But for purpose of portfolio hedge, I am personally not a fan of using the VIX for such a thing.
Yeah, I think VIX makes a better hedge strategy for an option hedge. I don't think it's a very good hedge for an equity hedge. My head is, I usually, for hedging, my general hedging rules is you keep your apples with your apples and your oranges with your oranges. So Mike's idea of, you go to like broad-based index, like SPY or SPX, a put spread, because that's what you own. So you want something to mix with that. The VIX actually works well as a hedge for a lot of option spread positions. So, it's a good place because you would own the VIX options and your short spread somewhere else. I think it makes a much better hedge because the VIX only kicks in really when you need to, and then you collect your premium on the stuff you sell. So I think that way, VIX does well that way. So I would agree with you on that score. Keep your hedge to where you need it to be. And oh my gosh, we have to close the mail block. We are running out of time. It's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, this is Around the Block. This is our part where we just ask our partners in crime, and I only have one right now. I asked Mike, what is on your radar for the rest of the week?
Well, tomorrow should be interesting to see what the market does once it digests the Paul Ryan thing, and watching the markets tomorrow, and then over the weekend we'll see what Bitcoin does, and then I believe we have another exchange getting into the mix with Bitcoin come next week. So a lot of things to be watching.
I think too, seeing if we get any kind of a bounce. I'm just looking after hours. Things are kind of sideways, and after the crazy rally we've had, very close to all-time highs. 10 handles off, right? You didn't get to say your favorite thing to say at the beginning of the show, but I'm looking at the same stuff, seeing really how volatility reacts, because there's a little bit of depression because of vol depression because of the holiday, and if we get really anything out of all of this, or we just kind of Goldilocks it into the end of the year, not Goldilocks, but Santa Claus rally, which it looks like it really wanted to do today. So I would not be surprised if that happens. If they do ink a tax deal, my big thing is it a buy the rumor, which people have been doing, and then sell the news on the tax deal. So with that, I think that closes our Around the Block section. And do you have any tasty things to tell our listeners, Mike, about what's going on at RCM Alts?
Many things, but if you want to find out everything that we have going on in terms of the excitement of working with a financial advisor who is not afraid of various option terms, including volatility, including ROW, including gamma, give me a call, 312-212-3531, or shoot me an email at mtosaw@rcmfs.com.
And with that, I'd say Mike does a very good job. So if you need somebody, he is definitely there for you. For me, for Option Pit, we are having VIX Made Easy. It's our 4-part session. Actually, it's a 5-part class. The free part was already 2 weeks ago, but we're starting it tonight. Also look for our volatility newsletter that's coming out. It's been on a dry run inside of Option Pit for about 5 weeks. It's been doing okay. So people like it, and we will be launching it for the public consumption soon. And with that, good trading, and we'll see you next week right here on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.